I think your industry should also, do the same thing and work out with institutional brokers to see that there is a greater coverage of these InvITs. And I think you are doing something very, very significant in terms of, bringing that data bank, that comparatives. Today, I think you will be releasing something.
The associations are doing a very good job on that. So one question, one subject that you mentioned was interregulatory discussions. So always a vexed question. We grappled with this. I remember when I was doing the competition law also, we grappled with something like this. Because you have the competition regulator, you have SEBI on the other hand, there's acquisition of listed on the stock exchange. How does the competition authority deal with it? So interregulator issues are always very vexed issues and thorny issues because each regulator tries to protect his or her domain in that sense. And yet, how they can all interact together becomes very, very critical. You touched upon that. How do you see that happening insofar as, because when you have mutual funds, you have the IRDA, so you are there, and you have MOF, RBI, everybody looking at it, and perhaps from a different lens, a different perspective. So reconciling perspectives, and it's a challenge in some ways, and yet quite necessary.
I think coordination as a challenge exists in every small office that we have. Even if you were to see in your own organization, if you have two departments, you will have a challenge. Then you rename that department, bring both of them together, then you will have challenge of coordination between two individuals who will be having some areas of responsibility. So coordination is a task which the human beings have been, facing since they became human beings. But there is lots of, I would say, which distinguishes us from other animals is the coordination. So we have created all these societies and structures and, from small tribal hamlet or, village, we have moved to big empires, because we have expanded our ways and means of coordination. Today, if you see that you are creating a fictional organization, you just create a company. What it is, where is company, who is seeing where the company is, what its assets are, where the things are located. The entire thing is working on trust because there are several people who are coordinating that information, and somewhere sitting someone in New York or China is investing some money in India, believing that such a company exists, the assets exist, that there is a production, believing those numbers. And we have coordinated it through regulators, coordinated through auditors, coordinated through... So therefore now, inter-regulatory coordination is something which needs to be there. People talk about single coordinator, single regulator. You may do anything. Eventually there has to be coordination. So question is, how are we trained to think of anyone as a customer? Now, if 4 people are thinking that as a customer, they all should actually come together in order to service the customer.
So hearing this from you as a regulator is such a positive message to everybody, and there's so much hope that there will be regulation, there will be coordination, and all the thoughts, sitting together to sort of sort out all the issues and different perspectives. So one of the buzzwords today in governance, and you have focused a lot on governance of REITs and InvITs, is ESG. Is SEBI thinking about ESG objectives for REITs and InvITs? Because I understand that there has been one sustainability-linked bond for a REIT. So what is SEBI's thought on that?
So sustainability itself is important, but sustainability we are also looking at in a practical way. We had, as you know, a BRSR, which has got a certain 1,000 listed companies that do it. Then we have said move for assurances, and then we turned it whether it is a reasonable assurance or whether it is an assessment, and we have said okay, either way. And then we said okay, 46 indicators form form a BRSR code where the people will be invested in. As we have more data, more availability of, so that we don't have greenwashing there, we go slowly, progressively, and then we have a value chain, where value chain we are saying, started defining. So, and then we have a green bond, yellow bond, blue bonds, sustainability transition bonds. And obviously, real estate industry is, in many ways, can do a lot of good work through, working with ESG, because a lot of these things that you are doing as green buildings, green space and others, you are actually opening up yourself to a very important investor class who is actually looking at these things. So therefore, it's important that, the industry moves with the ESG with speed, and greater amount of information is put out, so that there is a greater number of investors will be prepared to invest in your industry.
So SEBI would look at a voluntary compliance in the first instance, and then over a period of maybe look at something different. So one question I have is not technically related to this, but India's bond market could be deepened a lot more, because we have different kinds of bonds, they get listed, unlisted, but how do we build the market for that, deepen the market, the trading of the bonds and other things? Any thoughts on that? So, not related, but very important, because everybody raises funds through bonds.
So one bond market has developed, so not to say that, bond market hasn't developed. So a lot of efforts also SEBI has put in consultation with industry. You are now about 57 trillion, outstanding. If you look at proportion of bank credit, what it was before 5 years and now, there has been a steep, if it is, you have 87 trillion rupees there and you have a 55 trillion rupees there as outstanding bank credit to outstanding corporate bonds. So certainly outstanding corporate bonds are catching up with the bank credit quite fast. The second, we have said that, okay, is largely a privately placed market, it's a bond market. We have said, okay, for price discovery, lowered the threshold, you come to an electronic bidding platform, and that is quite unique in India, that you have a price discovery platform. Then we said, okay, how do we bring the retail in? And the retail investors had just no way to get into the corporate bond market. So then we had an industry which was already developing on its own, called Online Bond Platform Providers, OBPP. SEBI came in and started regulating it, and then prepared this OBP and reduced to 10,000 rupees the possibility, with 10,000 rupees you can buy a corporate bond from the OBP, and the OBP enables you to do that. Now the question is that how do you really do the exits? Where is the liquidity? And that is really the biggest challenge that we have. The liquidity in the market, because still it is hold to maturity market. And unless the people are there of different kinds who are prepared to exit at different points of time with certainty, people won't get in. And lastly important, and there what we are trying to do is to really say, okay, can we do better market making? We had said, okay, with liquidity options, we said put options. When you're issuing a bonds, you can have a put option so that, people can buy it. But very few issuers have taken it yet. But that is one area, liquidity area, that we need to work. We also have to slightly change the regulations in a manner where we treating the brokers of the bonds in a different way than the brokers of the stocks. And finally, we must also do a massive education for retail in bonds, because people don't understand the bond as much as they understand equity, because there is very little education which has gone into it yet.
So the investor education or the education in this market would be quite important for SEBI. So as a final question I have, you have shared your vision for the REIT and the InvIT industry. Mr. Kant has also said how good the future is. We are just at the beginning, at the threshold. What would you like to see or expect from the various stakeholders? What is your ask from the various stakeholders?
I think I've said it in my speech where we have to have, if you have to say the industry has to constantly work together. First, they were not organized. They have organized themselves because having an organization helps you put in a lot of doing common industry work rather than your own individual InvITs or individual REITs. So you pull your health work together. You identify issues, you take up the challenges. On the regulator side, of course, we need to constantly work with industry as well as looking at investors and see how this particular asset class is promoted in terms of depth, in terms of liquidity, in terms of diversification.
Thank you, sir.
And the other side, Mr. Amitabh Kant has very eloquently spoken about, the government and the other assets who are holding a lot of assets on infrastructure as well as on the real estate side. Whether they can do that, and that can be a pattern of, and there I think the industry, as they progressively work with state government and the central government, there will be
I think there should be
very good case for them to bring in more and more such thing. And with every new experience gained, they can also bring more assets into the market.
I think if one is successful, that the next follows. I think the government also gets more confidence with the one successful in which, and then, so you have been so much experienced with the disinvestment. And so one would hope that over a period of time, you could persuade different public sectors, government basically, to start also bringing in the unlisted, to begin with the unlisted company, infra companies, and their assets into InvITs, and grow the industry even bigger. Thank you so much, sir, for sharing your views, in-depth views. Thank you, everyone. Thank you, sir, and thank you, ma'am, for leading this discussion. I request both of you to please stay on stage. I would like to invite on stage Mr. Alok Agarwal and Mr. N.S. Venkatesh. I request you to please come on stage and present our dignitaries on the stage with the state
building. They democratize access to high-value assets and deliver real cash returns to unit holders. India's REIT and InvIT sector is still emerging, with significant room to grow in depth, scale, and diversification. Globally, REITs are a mature asset class. For example, US REITs alone manage over 360 trillion rupees of assets, while countries like Japan and Singapore have deep, well-diversified REITs markets. Collectively, REITs account for about 57% of global listed real estate market capitalization, whereas India's share is still around 12%. But I must say that we have just scaled up from nowhere. We were quite late in starting, but when we have started well. Let me now speak about retail participation, liquidity, and governance. Retail participation and REITs and InvITs is still low. Our investor survey shows that awareness about these instruments is around 10%, with penetration less than 1%. This must change. The retail investors should see these instruments as natural options in their portfolios, alongside equities, mutual funds, bonds, and bank deposits. SEBI has taken several measures to make these products more retail-oriented, enhanced liquidity, and well-regulated. Let me highlight a few of these. On the developmental side, the REIT reclassification. The reclassification as equity will enable equity mutual funds to allocate more meaningfully and pave the way for index inclusion and passive flows. And that will also leave more room for the funds to flow into InvITs on the hybrid side. Reduction in minimum investment. Lower thresholds for InvITs will increase the number of potential participants and improve liquidity. Creation of SM REITs. This regulated product will allow smaller, high-quality real estate assets to be accessible to retail. Strategic investor. The scope has been broadened to enable a wider set of domestic and foreign institutions to anchor REIT and InvIT issuances. Investor outreach. These programs on REITs and InvITs are being specifically held for retail investors, investment advisors, and research analysts. Let me come to ease of doing business measures. Cash flow management. Holdcos can now offset negative cash flows against SPV cash flows before distribution to the REITs and InvITs. Reporting timelines. These have been aligned with those applicable to financial results. On governance, we have introduced e-voting and video conferencing. Investors to be mandatorily provided these options so that they can meaningfully participate in governance. Investor charter. The charter clearly spells out rights, responsibilities, do's and don'ts, and grievance redressal mechanisms. Role of boards and trustees. We have strengthened the roles of trustees and managers and given significant unit holders rights to nominate directors on the board of manager of the REITs and InvIT. The way forward. We are actively engaging with institutional investors to deepen their participation in REITs and InvITs. We are coordinating with the Ministry of Finance and several state governments to accelerate public asset monetization. We are working with IRDAI, PFRDA, and EPFO to facilitate greater participation from their entities under their purview. SEBI will work with all stakeholders to facilitate the inclusion of REITs in indices through an appropriate glide path. Based on industry feedback, we are evaluating further ease of doing business measures for REITs and InvITs. We are examining a proposal to expand the pool of liquid mutual fund schemes in which REITs and InvITs can invest while safeguarding investor interests. We are also exploring whether private InvITs too may invest in greenfield projects with adequate safeguards. Municipal bonds and state-level InvITs naturally complement this ecosystem. The recent announcement of the Maharashtra government to create a Maharashtra Infrastructure Investment Trust is an important step in funding infrastructure at the state level. We are also delighted to see that NHAI has decided to establish its public InvIT, which will be available to retail and domestic investors for investment. This ushers in a new era of public involvement in building India's highways. In closing, while the opportunities are immense, this market is still at a nascent stage. SEBI will provide the enabling framework and guardrails, but it is the industry, sponsors, managers, advisors, industry bodies, and intermediaries that must believe in its own potential and build a deep, liquid, and trusted market. Our expectations are clear. Governance and investor interests will be non-negotiable. Use your associations, your digital presence, and your networks to educate investors in multiple languages. Our investor survey shows, which is in fact the first such a wide investor perception survey, that people like to be communicated in the languages they understand from the point of view of investing. 47% of the investors want to be communicated in Hindi, only 5% in English, 7% in Tamil, 7% in Bengali, Marathi, Telugu, Odia, Bengali, and so on. Assamese. We have to reach it out, and now we have really the means available, the AI tools available to really reach out in more ways than one. With stronger benchmark and disclosures, you can offer investors the transparency they need to stay invested. India's infrastructure and capital markets journey is now one and the same. If regulators, central and state governments, sponsors, investors, and industry associations pull in the same direction, the impact will be visible not only in assets under management, but in faster execution of projects on the ground, better services for citizens, and more resilient returns for investors. Thank you. Jai.
We are very grateful to SEBI Chairman Mr. Pandey for taking the time to join us today and for sharing his vision for REITs and InvITs in India. Please give him a huge round of applause. Thank you so much, sir, for coming here. We would like to understand from him what would drive wider adoption of REITs and InvITs and possible solutions to the challenges that they face. And I would like to invite on stage Ms. Pallavi Shroff, Managing Partner, Shardul Amarchand Mangaldas on stage. Please give her a round of applause and welcome her on stage. She will be leading this conversation with the SEBI Chairman on what should be the next steps to make REITs and InvITs more popular, perhaps amongst the retail investors. Over to you, ma'am. Request you to please steer this discussion.
Thank you. Good morning, everyone. Sir, it's indeed a privilege and a pleasure for me to be here and have this conversation with you. So we've just heard the potential of REITs and InvITs in India, and you yourself mentioned what huge potential it has for unlocking and building India's infrastructure to enable it to go to the 30 trillion economy. REITs and InvITs are a relatively new instrument for financing, I would say, at one level, and unlocking the potential for infrastructure and the real estate. Also, at one level, clean up a lot of the real estate issues that we face. In 5 years since the first REIT, we've had now 5 REITs in 5 years, which is quite phenomenal for a country like us. But yet, this is just the tip of the iceberg. How do you assess the state of India's REIT and InvIT market in comparison to the global benchmarks that you have yourself mentioned? Also, what would you be your top priorities to strengthen this market? You've touched
touched upon this very briefly in your speech, but if you could elaborate a little more.
Okay, first of all, I think I must say that the industry and the regulators, they've worked together hard in the last few years to take it to the 9 lakh crore plus from a very little, AUM 10 years back. So we have actually, the initial years are always difficult in an industry because people have to understand and you have to fine-tune the regulatory systems and so on. So that's, in fact, a little bit heartening. If you see, the market has grown at impressive 22% year on year in 25. India is now the 4th largest REIT market in Asia, behind Japan, Singapore, and Hong Kong. And these have been doing the REITs for a long time. Currently, over the past 5 years, REITs have mobilized $15 billion. Total assets have doubled from $37 billion in FY20 to $73 billion today. But if I say the benchmarking with the industry, we are still lagging mature markets in terms of diversification of asset classes, market depth, and liquidity. In US, Japan, and Singapore, REITs are constituting, as I mentioned in my speech, more than 50% of the listed real estate market capitalization, whereas India's penetration is just 12%. However, when benchmarked against mature markets, India presents a compelling value proposition. Indian REITs offer distribution yields between 6 to 7.5%, significantly outperforming developed markets where US averages 2.5 to 3.5%, Singapore 5 to 6%, and Japan 4.5 to 5.5%. So India is in fact ahead of these markets in terms of benchmarks, in value proposition. Now, how do we really do it?
How do we want to grow this to its true potential?
Yes. So there is a potential. The industry is doing well, and now what are the things that we need to do, and what are the priorities which need to be done? So first of all, of course, is enhancing market access and liquidity. Liquidity is important. Liquidity will improve when we have more of different players coming into the market. We have entry, exit possible. And one of the points on liquidity on the REIT side we have done is to classify them as equity so far as the mutual funds are concerned. So the mutual funds then can invest in this. And there is also foreign participation, which will, if it is classified as equity, it will be a greater passive flows into these markets, and liquidity will improve.
The InvITs, on the other hand, continue to remain hybrid instruments.
Yes. So
more in the nature of a debt, so investments.
Yes, I think to that extent, we have to see the slightly different nature of InvITs and REITs. REITs offer a little bit of a natural capital appreciation, and it also in terms of the ownership, because InvITs in many ways, the assets come back to the asset holder after the concession period. So there are certain differentiations, but for the time being, that itself actually feels, because many people would like to use InvITs, hybrid instruments as an important instrument, both from tax efficiency point of view or otherwise. So therefore, there will be a greater flow, like putting them into a different thing, at least from the major institutional investors' point of view, like mutual funds, will allow them to actually put more money into these instruments, because there are independent limits for liquidity, investing in equity as well as in hybrids. Now, expanding investor base is another one. Where can you, bringing in participation, pension funds, insurance companies, and large NBFCs. So we have brought them as anchor investors, providing stable long-term capital flows. Regulatory simplification and operational flexibility.
But also when you say the QIP, anybody who can invest in a QIP can invest in REITs. I think that also expands the investor base for the amendments that have recently been made.
One important element in this is, as my senior colleague Amitabh Kantji mentioned, and he really pushed it hard. As Niti Aayog, CEO Niti Aayog, and brought for the first time a national monetization pipeline as an issue which Honorable Finance Minister at the time, unveiled. It was a 6 trillion rupees plan in the last 5 years. The next 5-year plan is, at least from the Government of India side, is a 10 trillion rupees of plan, where some of the sectors are actually doing quite well in terms of national highways. They were still on private side, and their decision to come as a public InvIT will add huge number of new investors, including retail investors, to this arena, and they have a big potential because national highway pipeline can keep on adding.
So you mentioned a very important aspect in your speech, is now the National Highway Authority is doing an InvIT, and it's the first where, except for Power Grid, which has done one before, where the public sector is putting its assets into an InvIT. Do you see this as the beginning for many more public sector undertakings to put their infra assets, maybe NTPC or any other? They are the more traditional assets, but which could actually set the trend and increase the volume.
So we have to also understand a little bit of clearly the little bit of contradictions which and overlaps. Because if we don't understand it, we will be just moving in this way. Now, when it comes to public sector, many of the public sector, they are listed entities. When you are a listed entity, you have your own shareholders too. So you have shareholders on the one hand, and the new unit holders on the other. What are you trying to do? For example, say X entity, this is listed, and you have shareholders. The shareholders have, through the assets which the listed entity holds, get the returns, and shareholders want a certain amount of return. Now, if that listed entity brings in unit holders, it actually separates that particular assets and basically tries to monetize, and either through securitization or through InvITs or through TOT or through any of those measures, it tries to front-end the returns. So in a way, it is like you value those assets, you put it here, you extract that value, and now you are left with cash. Now this is the cash of the shareholders. You must be having an investable proposition in order to do that. So if you have a big capex plan, and then you have to have a cost of borrowing vis-a-vis the cost of return which you are giving to the unit holders. In case your cost of borrowing is 6% and your return is 9%, unit holders, in a way you are short shifting the shareholders by 3%. So it will lead to fall in the shareholders, your share price, because you have actually not, unless and until the cash which comes in is deployed effectively at 12% plus rate, the shareholders are going to protest. So when it comes to listed entity, they have to do it carefully, wherever it is there. But when it comes to unlisted entity, there, they need not get into the listed space directly as a shareholder. They can actually get listed through units directly. Bringing the units and shareholders together into that space creates a little bit of a contradiction that who gets what. And unless and until you have a model, business model, which clearly this thing, otherwise it will not work. So I would say a very big chunk of thing will be when you are building up the new asset classes, right at the building stage, you are straight away going for InvITs, not really caring to list those companies as the bringing in shareholders. And you have a lot of scope also exists for the, NHI, for example. It's not a listed entity. So it's a whole assets they can easily turn into, different InvITs. State government entities, unlisted companies. they can easily do it because then only the unit holder, which is clearly visible.
And it could be a listed InvIT or a REIT. And
the InvITs are getting listed, so why should you list the company, you list its
you don't need
units
to do
also.
both. This is
You need
another
not do
way
both.
of reaching out to the shareholders or reaching out to the public and getting funding for the long-term infra project. So when you, on the one hand, you have a new nascent sector and a nascent instrument, and yet you need to regulate. So where would you think is that fine line, a balance between investor protection and regulation, and regulating the sponsors, the managers? They need flexibility, new instrument developing, and yet you need to do investor protection. So how would you draw a fine line in that?
So on the investment protection side, right from the beginning, if you have to develop an industry, you have to be clear that the investors must build trust in those instruments. So some of those things that you have a mandatory, you have to have a distribution, 90% of net cash flows, you have leverage, you have investment cash, 4-tier structure, robust governance. This foster investment trust, and those are the things that will allow an industry to develop. And then you also, our recent reforms have also permitted innovations, because if it is too, so we have to provide operational flexibility. Like sponsors and managers can now use interest rate derivatives for hedging. The transfer can be done units intra-group, within the group. Then streamlined reporting formats. Then strategic investors, allowing them to come in so that you can diversify the capital base. While we establish the minimum holdings and lock-in periods, we also allow more people to come in, have the skin in the game, but still have the operational flexibility. So it is like, striking a balance between investor protection as well as giving progressively better flexibility in tune with the requirements of the industry.
So we've seen, everybody's seen that SEBI has worked very closely with the industry, understanding their concerns, needs, keeping investor protection in mind. And these last amendments that have come in September are, I think, an indication of how, at the one level, you are flexible, understanding, and making the industry grow. Would you be willing to consider, is SEBI considering further issues like combining the operating assets with under construction assets, or the risk-based leverage thresholds, so that the thresholds that you prescribe for debt may be flexible in certain cases?
No, I think that we have done, for example, minimum investment threshold for privately placed InvITs has been reduced from 1 crore to 25 lakh. It significantly expands the potential investor base. Then, it was a major accessibility barrier for the affluent individuals and family offices. So they can actually, by bringing down from 1 crore to this. Then also there is, clearly we have a right path for using operational flexibility, as well as the, in terms of, for example, using the under construction projects to also be included in a certain way. So these are the things which will be there.
So what about market making frameworks, or maybe a better analyst coverage? Today, I think one of the things that could be done rather easily by SEBI is to encourage greater analyst coverage of REITs and InvITs.
Yeah, I think the industry should also be talking to the sell side. Why aren't they covering it? I think they should be progressively covering more. It's a question of, whether there is sufficient demand for it. Because so far, I was having a session with the institutional broking industry the other time, in respect of the concerns they had on some of our proposals on mutual fund side. And they said, oh, these proposals will actually kill sell-side research. And then I came to know at that time that out of several thousand stocks that we have listed stocks, the coverage is only about 350 stocks. So which means that, unlike China, where there has been a huge amount of work under the institutional broking side in terms of coverage of stocks. So I think it's very, very important that our research industry develops further, because if you have greater amount of research available on different types of stocks, including REITs and InvITs, you would have a greater confidence for the institutional investors to use that knowledge to take investment calls. So it is something which we have to actually think about. And I think that interaction gave me a little bit of thought as to we have another work to do, how to promote sell-side research and promoting this the question that you are raising.
Yeah.
I think your industry should also, do the same thing and work out with institutional brokers to see that there is a greater coverage of these in this. And I think you are doing something very, very significant in terms of, bringing that data bank, that comparatives. Today, I think you will be releasing something.
The associations are doing a very good job on that. So one subject that you mentioned was interregulatory discussions. So always a vexed question. We grappled with this. I remember when I was doing the competition law also, we grappled with something like this. Because you have the competition regulator, you have SEBI on the other hand, there's acquisition of listed on the stock exchange. How does the competition authority deal with it? So interregulator issues are always very vexed issues and thorny issues because each regulator tries to protect his or her domain in that sense. And yet, how they can all interact together becomes very, very critical. You touched upon that. How you see that happening insofar as, because when you have mutual funds, you have the IRDA, so you are there, and you have MOF, RBI, everybody looking at it, and perhaps from a different lens, a different perspective. So reconciling perspectives, and it's a challenge in some ways, and yet quite necessary.
I think coordination as a challenge exists in every